Economic data dominated the headlines this week, giving us a solid look at the state of the economy. Top moments included the August jobs report, GDP, consumer confidence, and personal income and spending. We broke it all down for you here on Yahoo Finance. Take a listen.
The long-predicted recession has been kept at bay for now, thanks to a robust job market and resilient spending. But will the good times last? Well, while retail sales grew stronger than anticipated in July, several companies cautioned of a spending slowdown in their earnings outlooks for the year. Now, a new batch of data out this morning will give even more insight into where the consumer is headed. Today's JOLTS numbers out in less than an hour will be closely watched for any sign of a slowdown in openings ahead of Friday's jobs report. This week's series of key employment data will provide crucial insight into the strength of the labor market as the Fed debates their next rate hike move. So where will the consumer take the economy? Joining us now to discuss is Caleb Silver, Investopedia's editor-in-chief. Good to see you, Caleb. So break this down for us in terms of how retail investors are looking at this environment right now.
Yeah, I think they're a little bit sketchy right now. We had such a good start to the year and then a pretty intense pullback. And there's this general fear on both sides, whether they're fear of missing out or the fear that things have come too far too fast, especially in some sectors. So when we ask our audience, our readers, what would you do with an extra 10 grand? Most of them said they would try to buy extra stocks with it, but a lot of them are sticking to CDs and money market funds. Searches around best CDs, best high yield savings accounts, and best money markets accounts remain strong. They've been strong all year because investors are like, maybe I will take 4 or 5% until I really believe that the rally is going to be for real or will resume for real. So we've been watching that pretty closely right now. That said, we have a lot of individual investors who like putting money to work on Investopedia, and they're just waiting for the right moment to get back after it.
Caleb, we had a report from Best Buy this morning that we were just running through, and one of the takeaways was that the executives are hopeful that consumers will be more apt to continue purchasing should they see the right discount or should they see the right sale taking place. Is the data right now telling us that this is a consumer that is still gleeful to go into a Best Buy, to go into a Home Depot, and confident in making a purchase in a big ticket item as long as it's on sale?
I think that has a lot to do with it. That said, I think we're at the tail end of that revenge spending coming out of the pandemic now, a year or so removed from the fact that we can go out and do whatever we want. So you saw that shift from first we had goods, and then we had a lot of spending in services, a lot of spending in travel, people going to see folks, people taking big trips, the experience economy. And I think right now people may be tapped out. And then Rochelle mentioned it, we do have the resumption of student loan payments coming up here in about a month. That should take a pretty big toll on spending for about 40 million Americans.
And Caleb, are we getting some clarity into what people are spending on sort of within services? How are they still willing to put that money to work? Even though, as we're looking at credit card debt mounting, they're clearly not able to sort of balance that budget right now.
Yeah, well, travel was very big this summer. We did see that spike in gas prices over the last month or so. I think a lot of people put money into that. But I think people have also been spending in and around their home and their home experience, trying to get that ready for the fall, for the back to school season. So consumers, again, feeling a little bit tapped out here. Investors, again, on the fence, should they stay or should they go? It's kind of a clash moment for a lot of investors wondering which direction the market's going to go and if momentum is going to be there. You know, the stock market, when the stock market has such a strong first half of the year like we had, it produces what we call the wealth effect. It makes people feel wealthier because they're watching shows like this. They're seeing the averages move higher. And then when you get this pullback, you get this feeling of, oh, are we about to have another moment like we had back in 2020 or like we had last year or like we had in 1999? So there's still a lot of psychological damage from those crashes.
I think we all look at charts like the one that was just up and think about what that credit card spending leads to in terms of long-term debt and what broader implications that has on the economy and the consumer even further out from here, because that's something that's been cited in terms of the delinquency rates that are now rising from many of the retail CEOs over the course of this earnings period too. How concerned should they be about those delinquency rates and the long-term ramifications?
Yeah, well, right now they're pretty small, though they are growing. We're seeing a higher trend. The Fed noted it in its report recently about the record credit card debt. So that's starting to boil up. And that hurts lower income folks the most because they can't avoid the big spend at the grocery store. They can't avoid filling up their car with gas and shelter. Those are the three things that are costing the most right now: food away from home, shelter, and gasoline prices. So they can't avoid that. That hurts that lower income consumer the most. The higher income consumer is doing okay as long as they're employed, and we have seen wage growth at 4.5%. So that's buffering some of that a little bit, but I think we're going to see the slowdown first in the lower income and then move its way a little bit higher.
And obviously, a lot of these retailers still want to be attractive to some people who are, trying to be a bit more budget conscious. How do they walk that fine line between not discounting so much that it affects their margins versus still being able to attract all these consumers and try and scoop up those dollars?
Yeah, look at the retail earnings we've seen so far. Target obviously not performing very well right now because people are being a little bit more cost conscious. And then you look at Walmart, which had a much stronger quarter, but Walmart has a lot more broader offerings. They have the groceries, they also have the goods, and they also stack them high and let them fly. They're willing to discount at scale because they have enough sales volume to handle it. But some of these other retailers, there's a point at which it really hurts their margins too much to keep discounting. And if the consumer doesn't feel strong enough to make purchases, then discounting doesn't really make a lot of sense. But take it outside the retail sector for a second and look at a company like Tesla that's done intense discounting to move volumes. That's actually worked for the company because it continues to grow market share, even though it's cut way into its profit margins.
And that's about the equivalent of higher the inventory in the aisles, the closer to God. We'll workshop and see how that goes over for some of the retail watchers out there. Just while we're on this topic, though, too, as we look through what's taken place over the course of back to school season and then try to layer on to what that means for Labor Day and then even further on into the seasons, then we get into holiday shopping season. Is there anything foretelling about what back to school season has seen that we can extrapolate and apply to the holiday period as well?
Yeah. Well, when you look at the back to school items that we've been buying, a lot of things are more expensive this year than they were last year due to inflation, but we have seen drops in meaningful areas. Cell phones is one of them, right? Cell phone plans, actually cheaper than they were last year. That said, musical instruments, clothing, especially clothing for women and girls, that's more expensive this year. So we have seen people buying the necessities and getting ready for the back to school season, but I'll bet you both that we're going to see that holiday shopping, that Christmas shopping season start even earlier this year than it did last year. They keep rolling it back. I bet you by October we're going to start to see some of that come up.
I mean, look, the more and more pumpkin spice latte season continues to get pulled forward, everything else, so too goes with it. Just lastly, while we're kind of on this topic and kind of rounding out the consumer, it comes back to wages. It comes back to what they're making. And particularly here, even as we're looking through where those opportunities are, we're kind of evaluating the JOLTS report that's just come out as well and trying to figure out as we're leading up to the monthly jobs report, what for that month-over-month wage movement, how the consumer is thinking about where they're able to still put their wages to work and how they feel about their spending too.
Yeah, as long as the wage growth remains in areas, in the middle to lower income jobs, that's going to be strong. Higher income folks are doing just fine. They can handle it. But as long as we continue to see wage increases, again, in those $75,000 to $120,000 jobs, you'll probably see some stabilization in spending right now. But we have to watch that pretty closely. You are seeing a really strong labor movement this year, obviously with UPS. They got a nice raise. UAW's workers have authorized a strike on the big three automakers. If they get wage increases, that could be meaningful as well. That would go out again 4 years. But the psychological impact of workers being able to get more from their companies, that's very important right now. And as long as we don't see steep job losses, you'll see some confidence in spending. The consumer's going to remain pretty confident. But if all of a sudden we start to see big layoffs happening, if we start to see the private sector, we'll see those ADP private payroll report on Thursday. If we see that starting to show some slack, that could be trouble.
The revised estimate for US GDP came in at an annual rate of 2.1% in the second quarter. That's down from the first estimates of 2.4% as a drop in exports offset the tick higher in consumer spending. For more on this is David Doyle, Macquarie Group Head of Economics, joining us now. So I want to get your takeaway from this revision as we try and understand the actual health of the economy and what this actually means for the Fed's job as they try and manage interest rates with this sort of data in mind.
Yeah, so this is a fairly modest revision. I mean, just down, 0.3 percentage points on an annualized basis to 2.1%. versus 2.4% previously. And the underlying component suggests that, a lot of that was due to, or at least a hefty component of that was due to the pace of inventory building, which actually mechanically, could provide a boost to 3Q growth. So I'm not overly concerned about, the revisions that took place in terms of what they're suggesting about the pace of growth in the second quarter. But what I did find interesting is that we did get the first release of real gross domestic income, which is an alternative way of measuring output. And, historically over time has tracked real GDP quite closely. That came in at just 0.5%, so plus 0.5% on an annualized basis in the quarter. So suggesting that growth was a fair bit weaker. And that sort of continues a trend in divergence that's occurred over the last 4 quarters or so in those two measures. And it suggests to us that potentially the economy isn't as strong as what the headline real GDP numbers are suggesting.
How can that play into the mind of the consumer from your perspective, David?
Look, the consumer, we think, is poised for some struggles ahead. In large part, the gains that we've seen over the past year or so in consumption, they haven't been underpinned by strong real income growth. It's been more driven by a reduction in the savings rate, a reduction in the excess savings that had been built up during the pandemic. And as we look ahead, we think those are unsustainable sources of spending growth. As we look ahead to the coming quarters, there's challenges ahead. The pace of jobs growth is slowing. Credit availability is tightening for consumers. And then, of course, in October, student loan repayments are set to recommence. We think that'll only add to headwinds. So we actually think that consumer spending is set to slow ahead, and that could weigh on the growth outlook in the back half of 23 and into 2024.
And David, as you look at some of the stronger parts of the economy that are propping it up at the moment, what are the standouts for you?
Yeah, so there's 3 major standouts for us within business investment, and actually these 3, business investment had been an area of strength in the second quarter numbers, but a lot of that has been very concentrated. Manufacturing structures has shown phenomenal growth. A lot of that is related to the semiconductor industry and is coming on the heels of the CHIPS Act that was passed last year. Then you have transportation equipment, so aircraft, cars, like trucks, et cetera. That type of business investment has also been quite strong. And we think that really reflects supply chain healing. And then the third component, which interesting, tailed off a bit in the most recent revision, was software, which could be related to, AI spending. A bit unclear, though, in terms of what the mechanics are there. But those are the components that are really driving the business investment, which tends to be the most cyclical component of growth. We're skeptical on the durability of those components to drive business investment growth going forward.
To what extent is the GDP kind of calculus also kind of impacted by some of the weakness that we're seeing in other parts of the world, and most notably in the second largest economy in the world, in China?
Yeah, so there hasn't, I don't think that there's been much pass through directly from China into the U.S. economy. The U.S. is a largely, I would say, independent economy from that perspective. It has less trade outside of its borders than most other economies. And the trade that it does have, it tends to be with Canada and Mexico. It tends to be within those two components. Mm-hmm. The exports to China are fairly low. So I don't think that we've seen much impact yet on the data coming through from China. But that doesn't mean that it won't be forthcoming. You could see that in coming quarters ahead.
And David, as we look at the likelihood of a recession in the U.S. economy, I mean, some people are saying it'll be a soft landing. Others are saying, look, markets really aren't pricing in enough of a recession risk. Where do the estimates lie now?
Oh, I think opinion on that is still, I think, pretty divided. I think what you've seen over the past number of weeks, at least up until the last couple of days, was a period of very strong U.S. data where the numbers were coming in well above the consensus forecasts, and you saw a big increase in the economic surprise index, reflecting that. What do we think that means for the recession risk? Well, I think what it means is that while the recession risk is still out there, the timing remains quite nebulous. It's very difficult to pinpoint when things might deteriorate. People have been, I think, revisiting the timing on things in light of that recent positive data over the past several weeks.
David Doyle, Macquarie, Head of Economics. Thanks so much for joining us here this morning, David. Appreciate it.
Anytime. Thanks for having me.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Well, let's take a look at the housing market. It isn't showing many signs of cooling, even as mortgage rates hit a 22-year high. The Case-Shiller Index showed housing prices continued to rise in June. The national composite up almost 1% month over month and seeing no change compared to last year. Now, prices have held strong thanks to low existing home inventory. That's been a boon for home builders. Looking at home builder stocks, they're all up over 20% year to date. Luxury builder Toll Brothers said in its latest report that the average price per home in its backlog is $1.75 million. Now that's up from $1.43 million last year. Joining us now is Heidi Patalano, National Mortgage News Editor-in-Chief. So good to see you here, Heidi. We still have this very tight housing market here. Good news for home builders, though, but when do some of these home buyers get a break?
Right, that's a very good question. It seems like there is really no relief in sight for home buyers looking for some price breaks. Definitely, there's an inventory crunch right now, and that is keeping prices high despite the fact that mortgage rates are still inching up. We saw last week that mortgage rates hit 7.23%, the 30-year fixed average, which is just a high not seen in 22 years. And with Federal Reserve Chair Jerome Powell signaling last week that he's open to continuing to raise the federal funds rate, we can expect that rates will stay up that high. But as I'm saying, otherwise, those homeowners who would otherwise list now are not incentivized to do so because the rates are so high, which keeps supply so tight and prices up.
So I was doing a little TI-84 calculator here just before the show, looking at one of the recent reports that came out from a new home builder and Toll Brothers last week, just looking at the year-over-year increase that they're seeing in the backlog of homes that they're still delivering right now, and it came out to about 3.5%. A lot of buyers might look at that and say, okay, well, that is kind of pairing with year-over-year inflation as of right now. But where is it different for some of the home builders and the new home market when it comes to the delivery and that timeline for delivery, especially given that this is one of the more expensive home builders out there. And what does that spell out about the broader housing market too? If you have a company in Toll Brothers saying that, all right, we still need time to be able to deliver on all of these homes, and we've got significant backlog. And then at the same time, we need to write down where there is inventory that is unsold as well.
Mm-hmm. Yeah, well, it's an interesting question because, we saw that new home sales hit a high last week. Mm-hmm. And so but yet home builder sentiment is down slightly because the rates, because of the interest rates scaring off some buyers. So we're seeing some of them offer incentives to get people into those homes. They're offering breaks in the customization of the homes that they're going to deliver and in closing costs. So it's an interesting situation because there is that high demand. There may be a backlog that they're still catching up to, but there are certainly buyers for those homes out there.
So Heidi, as we look regionally then, and people are trying to decide, is it better to sort of get an existing home or try and wait for one of these new builds, considering, sometimes the cost can kind of add on as you go in with a new build. How should people be looking at how to decide whether to buy a new build versus some of the limited existing home inventory?
Well, I think it really depends on which market you're in. One thing we're seeing about the home price trends is that they're really varying quite a bit from market to market regionally. So we saw prices go up in certain parts of the country, in the Northeast, for example, but yet in markets like Seattle and San Francisco, we saw prices go down. And also that new home inventory isn't coming up evenly across the markets. So, I think it really depends on where you're at. The other thing that's an interesting part of this is that rental prices for single family homes have sort of slowed in terms of their growth. And so right now that is seeming like an attractive option in terms of staying in a rental and waiting it out for for interest rates to come down.
Heidi, we often talk about how student loan resumption and payment resumption is going to impact small purchases, things from the footwear that you might get all the way to whether or not you're going to buy a new television. But what about for that large purchase that a lot of borrowers are still trying to be able to figure out how they can finance in the future? How does student loan repayments now have a broader impact on that housing market?
Right. Well, that's a very good question. I've heard lots of different opinions on how that's going to play out. I've heard some say that, it's actually already baked in. This, like, underwriters now are still, they've always kind of kept in the student loan as part of the financial picture when assessing a borrower over the past several years, despite the Biden administration's measures with that. But then I've also heard that, psychologically, that's a huge burden to these potential buyers. And so that this may, in fact, scare them off of, thinking it's something that they can do right now.
Heidi Padalano, who is the National Mortgage News Editor-in-Chief, joining us here in studio. Thanks so much, Heidi. Appreciate it.
Thank you.
Job openings edged lower in July, showing that there may be some cooling in that hot job market ahead of Friday's jobs report. Now, the Fed is looking for some relief in the tight labor market as rising wages are helping to keep inflation sticky. Now, stocks popped on the news as investors have priced in a soft landing, hoping inflation can come down without causing a recession. But our next guest isn't so convinced that an economic slowdown can be avoided. Joining us now is Eddie Gabor, Key Advisors Wealth Management CEO and co-founder. Good to see you, Eddie. So you say that there's no way we can get to this 2% inflation target by next year without a recession. Break down your base case for us.
So look, in my opinion, when you look at the percentage basis you have to drop to get down to 2%, in our opinion, the only way you can get there is by demand destruction. I think the Fed obviously knows that. Now look, if they ultimately change and kind of flinch and say, well, 2.5% or 3% they can live with, that completely changes our opinion in regards to a recession. But again, I don't see how you can get that rate of change to drop that much by next year without a recession. So right now, we think the consumer is showing some weakness. When you look at credit card debt, then you have student loan payments having to start back up in October. So I just don't see it. I hope I'm wrong and we don't have a recession. But one thing I am convinced of is the market is not priced for a recession. And if we are correct in our assessments, it could bring quite a bit of volatility. And lastly, look, the JOLTS numbers causing some reprieve in the bond market today, but we're concerned that we're going to see a reacceleration of inflation when you look at oil prices going up back into the 80s. So we're not out of the woods yet with this fight with inflation. And so I think the bond market's going to continue to be very volatile as we get these mixed signals.
Yeah, it seems like the markets are priced for AI improving productivity and perhaps the Eagles winning the Super Bowl this year. But Eddie, as we think about more broadly going forward, this potential recession that you're calling for, are we talking about a shallow recession or one that's more mild from your projections?
So whether it's mild or shallow, I think the market, when you look back at history, whether it's mild or shallow, it's not good for the equity markets. You normally will see a double-digit drop in regards to the markets from the levels where they are when the market finally prices in the recession. And that is really our base case, that that's still in the cards. Now, look, without question, the market and the economy has been much more resilient than what we anticipated coming into this year. So it may be a story for the first half of next year. But again, when you follow the rate of change here and you're looking at the direction where the consumer's going, being in a consumer-driven economy, things aren't heading in the right direction. They are decelerating.
And we certainly keep hearing some of these warning signals in what we heard from some of these earnings calls and some of the forward guidance that they were looking at, sort of teetering on the edge of how the consumer is faring right now. And when you couple that with, as you mentioned, student loan repayments, credit card debt reaching some of these record highs that are also causing some concern here, when do we see that start to show up more significantly in earnings?
So I think you'll see that in the fourth quarter of this year is when you'll really start to see that. And again, if I had to pinpoint a time period where you'd start to see that weakness recognized in the market, that's probably when you'll see it. So we'll still get some rips and rallies and then some dips and maybe sideways. But I think in the fourth quarter is when we're going to start to really see that. And look, real estate is going to show some cracks as well, too. You have mortgage rates at over 7%. You're going to have a problem in the regards to those folks that have mortgages at 4%, 3% right now. I don't think you're going to see them putting their house on the market to sell anytime soon.
What's your top trade if we do see a recession?
Would be buying the long end of the Treasury curve, because if we see a recession, you're going to see the long end really drop, in our opinion, and that's going to be where you'll get that initial pop, and then you'll want to rotate into your higher beta plays. Right now, we're heavy into money markets, frankly, because of the yield that they're having, because we're still not convinced that the volatility in the Treasury market's over yet. But once that gets priced in, you should see the long end of the curve really come down.
And Eddie, what are some of the key questions that some of your clients are asking about the environment that they're in and how to play that right now?
So the biggest question we're getting from our clients, because our clients, many of them are retired, so this isn't their first rodeo, is they see what's happening under the hood economically with their businesses, where they live, and their local economies, and they're scratching their head as to why the market this year has ignored those fundamentals. So the disconnect between the fundamentals and the market is the number one question that we're getting right now. So we continue to talk about patience, and patience is one of the hardest things to have as an investor. But with short-term yields paying what they are, it makes being patient a lot easier today.
For companies that we've continued to monitor over the course of the earnings season, many of them citing macroeconomic challenges and how it could impact their company. But I think more broadly, for anybody who's looking around the world at where they're also being impacted, not just by the U.S. and the domestic front, but also the global situation. Are there pockets of this market that you could see turning earlier because of their exposure internationally, particularly here, Eddie?
So it's interesting you bring that up. We are bullish on India. That's our top equity position that we have, frankly. Because of the weakness in China, we believe that India is going to be the winner due to that. And I think you're going to see more and more companies invest in India and less in China. So India's economy looks like it's going to be accelerating over the coming quarters because of that dynamic. So it's not. So there are pockets, in our opinion, where you can make money in this environment again, but we think we are here domestically have some challenges, so we're being more cautious on the domestic front.
And as you said, they're easy to be at least patient at this point when you're looking at some of these yields. Always great to see you, Eddie Gabor, Key Advisors Wealth Management CEO and co-founder. Take care.
Thank you.
Well, the revised estimate for U.S. GDP came in at an annual rate of 2.1% in the second quarter. That's down from the first estimate of 2.4% as a drop in exports offset the tick higher in consumer spending. This slower growth news came as ADP reported fewer private payrolls added in August compared to July. That was down to 177,000. And the news seemed to send stocks higher momentarily as investors hope a slowing economy could mean an end to monetary policy tightening from the Fed. Joining us now, we've got Keith Bliss, Block's Cross Global Head of Markets and Strategy. Keith, great to have you here in studio with us.
Thanks, Brad. Good to be with you.
First and foremost, you look at some of the economic data readings that we've got over the course of this week. We still have PCE that we're yet to get. We still have yet to get the, of course, monthly jobs report as well. But what is this starting to spell out about what the Fed is most likely going to do, as all signs point towards nothing at September, but perhaps November in focus?
Yeah, I think we're going to have to wait and see some of these other data points as they continue to roll along. Certainly the data that we've seen is rolling over from the robust growth that we saw in the first and second quarter. I don't think it spells doom for the economy. I don't think it actually changes the calculus of the Fed. Very little, if at all. So certainly the price information is going to be the most important point that they're going to look at. The Fed focuses on the core PCE. That's what they're going to look at. Inflation is still, even though it's come down, is still higher than they want. So again, September is probably off the table for a rate increase, but later in the year we could see more price increases, particularly when you take a look at what the third quarter GDP estimate is out of the Atlanta Fed. They're tracking at a 5% rate at this point in time. So if you have 5%, you have interest rates. If you have 5% or even higher, that will be higher than interest rates. You still have a lot of capital sloshing around the system. That means inflation will heat up again and the Fed will be forced to move. So for right now, I think they stand pat, let the data play out a little bit, let the markets trade, get back into the busy season of September and October, and then reevaluate where they sit.
And Keith, Rochelle here. I mean, we saw that brief sort of spark with markets this morning as they saw that revised GDP data. But as is usually the case, some sobering tends to then kick into the markets as well. How should they be viewing this period? Obviously, we have a lot of data that's going to be coming out. What sort of investment mindset should people have at the moment?
Well, quite frankly, this is a bit of a punt here, but I think people should probably stand pat for the rest of the week. Think of the things that we have coming at us. At the beginning of August, the markets got broadly oversold, and they're just now fighting back. Yesterday was, I would say, an anomaly to the trend that we've seen throughout the month. And also bear in mind, Rochelle, that this is the slowest month of the year. People are just finishing up their vacations. They'll come back after the Labor Day holiday and get back to work and start reevaluating their positions. Portfolio managers, both in the mutual fund complexes, the large banks, as well as the hedge funds, will really start looking at their portfolios, start doing some tax harvesting, as well as understanding where they can book the gains so they can show outsized performance relative to their benchmarks. But for right now, this week, I would just stand pat. The markets are terribly neutral, fighting back to the neutral point with the S&P, the NDX, and the Russell 2000. So I would trade around the margins. There could be some good values out there. I'm not sure I would be entering into a large position in a company like NVIDIA, for example, who is bumping up against their all-time high, maybe rightly so. But just managing the positions, keeping cash, keeping your powder dry. There probably will be some opportunity when we get into the really volatile September season.
Yeah, being cautious of some of those Goldilocks scenarios right now in the markets. Yeah. But if there is a trade, then investors could perhaps kick the tires on going into Q4. Right. Going into an environment where a lot of retailers even have looked at back to school shopping and said, all right, this is giving us a little bit of inclination to believe that we're going to see a strong holiday shopping period. Is there anything that investors could be keeping an eye on or a top trade going into Q4?
Well, I think you raised a good point there, Brad. I think any of the consumer stocks going into the third quarter prints that we're going to see in GDP probably will get a good bounce. And if you make the bet that the Fed will stand pat, then those will be good places to put money. My own personal bias on a lot of the trades is on the short side right now. For example, bonds are starting to get overbought. We've seen that move yesterday from the JOLTS data and what we'll probably see here. So there'll be, in any of the bond ETFs, there'll be a good short position you could do there. And if you look out over the horizon, 3-6 months, you could probably put on a good short position in anything around the housing market right now. Housing will get weaker, especially if interest rates get up higher than they are. Talk about what's going to be the impact of students having to repay their loans. There's going to be less money in the system. Savings have come down pretty substantially since just after COVID ended. So there's not going to be a lot of money to be put into the housing market, especially as things stay a little bit more expensive and rates are still high.
And Keith, we are still seeing a lot of people being defensive right now until they get a bit more certainty. But then, of course, you also had Grayscale's win over there with the SEC, perhaps lifting some appetite for some riskier assets. What's your take on sort of moving into some of these riskier assets? Well, it's still very early days for what happens next with Grayscale's spot Bitcoin ETF.
Yeah, it is. I mean, it's an interesting situation. I think broadly speaking, Rochelle, when you look at the digital assets and crypto market, which is what we play in at BlackCross, mostly in Latin America right now, is that we're still very early days. What I think is instructive about some of the recent developments and judgments that we've seen, especially yesterday with Grayscale, is that cryptocurrencies, digital assets are here to stay. The recent kind of right sizing of the market that we've seen since 2018 and the recent crypto winter and the failure of FTX, those are very positive for the marketplaces. And so there's going to be excellent opportunities both in the private markets and eventually in the public markets to invest in digital assets companies. I would not necessarily suggest that people should be throwing a lot of capital into the very risky and speculative tokens, a lot of them that you see out there. But try to look at things like a Bitcoin and Ethereum, some of the other tokens that actually underpin real business models and developments that are going to happen on the blockchain and in other areas. Those would be the appropriate places to put. And some people would deem those as risky bets, and maybe they are a little bit more volatile than buying a basket of 50 stocks in the Fortune 50. But those would be good opportunities to take some of your discretionary cash, put them into those situations, and watch them appreciate. Because I'm a big believer that blockchain technologies, cryptocurrencies, digital assets, and all the innovation that comes along with that will accelerate dramatically in the next 3 to 5 years.
And we'll certainly be watching all of that. And of course, everyone, do your homework before you decide, which of these crypto assets to invest in. I do appreciate you joining us this morning. Keith Bliss, BlackCross Global Head of Markets and Strategy. Thank you for your time this morning.
My pleasure.
Well, the Fed's preferred inflation gauge, PCE, ticked higher in July, up 3.3% from a year ago, with the core print, excluding food and energy, rising 4.2% year over year. Now, this comes after the Fed reiterated its target of 2% inflation in Jackson Hole. Now, investors are still hoping that the slowing rate of growth means the Fed can hold rates steady at the September meeting. Joining us now with his perspective on what we can expect for markets is Sean O'Hara, Pacer ETF President. Good to have you on the show, Sean. So break down the reaction to this PCE data. We know that the Fed won't just look at one thing, and there's a lot of time still to go between these meetings. But what are your big takeaways as to how you think the Fed is looking at this data?
Well, thanks for having me. I think the Fed has been pretty consistent the whole time with regard to what they're looking at. They're looking at their target and they're trying to get there. I don't think what's currently going on in the market is going to back them off of their current path of continuing to tighten and potentially even raise rates some more. The big driver and the thing I think they're most worried about is that, the price of oil, for example, has gone up over 20% in the last 30 days. And oil's in almost everything. It's in transportation, manufacturing, it's in heating our homes and running our businesses. And so if that spike in energy sort of reverses the course of slowing inflation, I think that'll give the Fed everything that they need in order to continue on their path. I think the market has sort of been going up and down, if you will, based on two camps. One that thinks eventually they're going to pivot and bring rates down, and the other who thinks that they're going to continue to stay the course. I'm in the stay the course crowd, which means I think the market, as far as overall valuation, is potentially susceptible to a little contraction because inflation is remaining fairly stubborn.
So being in that stay the course camp, then, what are some of your stock picks at the moment to sort of ride this storm out as you're taking that view?
Yeah, I mean, I think in this environment, everybody's talking about the Magnificent Seven, and they're certainly, had a great run so far, at least up until the last month or so. I think perhaps the last month or so they've pulled back. I think in this environment, I think you want to buy stocks that pay dividends, give you a little bit of money today. I would think you want to lower your overall portfolio's PE before the market potentially does that to you. And so I think as you think about it, the energy names are historically cheap. We are overweight energy in one of our large funds. We like outside the U.S., for example. We've been underweight as investors here in the United States, international and global, and there certainly are cheaper opportunities to invest over there with single-digit PEs and in some cases very, very competitive dividends. So I think, you need to be thinking about, is it time to rebalance? I'm not saying completely get out of, tech and the big seven, but I think reorienting the portfolio a little bit towards other things makes sense. Every once in a while or so, we get in this position where a small number of stocks drive the market. It happens, but it never lasts. And so if you know it's never going to last, then you have to think, well, what does it not lasting look like? And it either looks like those big names come back down to earth, or the rest of the market picks back up and catches up. In either case, remaining cap weighted, in other words, just buying the broad index like the S&P 500 or the NASDAQ 100, doesn't do very well in that environment. If the big names come down, you're going to be overweight to those names, and so you're going to suffer from that. And if the rest of the market catches up to them, there's not enough weight in those broad indexes to really be meaningful. So thinking about alternative weighting schemes like equal weight or weighting your portfolio by something other than market cap is a way perhaps to think about the rest of this year.
And as you know, you say investors are going to live and die by 10 names on the S&P 500. The rest are almost irrelevant then. So then what are some of the risks and opportunities that come when you do have this sort of hyper focus on these 10 tech stocks that are really lifting everybody else? What are some of the risks and opportunities that come with that?
Yeah, well, the obvious risk is that those tend to come back down to earth, right? And so when you think about like the S&P 500, the bottom 50% of the names in the S&P 500 only take up 14% of the weight. So perhaps we should be looking in the bottom 50% in terms of market cap in the S&P 500 to find names that will give us better returns. We believe at Pacer in a metric on the value side called free cash flow yield, which is essentially just a measure of what you're paying for a stock in terms of the amount of free cash flow you get in return. And those strategies in the last 90 days have actually been outpacing the market. So we lagged the market with that strategy for the first 3 months. The last couple of months, they've been picking up as we've seen this somewhat of a rotation. So I think, again, you got to look outside of those big 10 names and can't be completely exposed to them. And you're probably too exposed to them if you own broad-based indexes like the S&P or the NASDAQ 100, because those names take up so much space in terms of the total weight in those portfolios.
And to that point, John, I mean, especially when you look at where valuations are, for some of these investors who perhaps didn't jump in and miss the rally, you mentioned also looking internationally. Where are some of the outside of the US opportunities that you see here?
Well, like global as an example, which would be sort of a combination of US and international, is a place where we have a fund that's done very well so far this year. It trades at a very, very low multiple and it pays a very competitive dividend. International has been somewhat cheap. And then if you want to stay in the U.S., small caps are something that perhaps you should look at. But again, I think you should be careful with small caps. They have a different problem than the bigger market cap weighted indexes. And that is the big small cap indexes, about 30 to 40% of those names don't make any money. And they're really going to get hurt by rising interest rates because the way they take on debt, which they tend to do more than large cap names, is through these 90-day revolver facilities like bank loans. And so as rates rise, it makes it more difficult for those that have this outstanding debt to kind of meet that debt service. So our approach to small cap is to limit it to the 100 stocks that have the highest free cash flow yield, for example, or the highest free cash flow margin. So buy healthy companies in small cap that are profitable versus chasing the whole benchmark.
Certainly important to point out those nuances there as people, try and jump on this rally and wondering where to fit in here, but obviously with some caution. A big thank you there to Sean O'Hara, Pacer ETF President. Thank you for your time this morning.
For more insight on this morning's jobs report, I want to bring into the program Acting Labor Secretary Julie Su. Secretary Su, thank you so much for joining me. It's great to see you.
You too.
The labor force participation rate bumped up last month. It's now at the highest level since pre-pandemic, February 2020. At the same time, we saw the unemployment rate go up, more people coming into the workforce, more people looking for work. Your take?
That's exactly right, and those two things are connected. So more people coming to the labor force, it's a sign of optimism, right? That recovery has happened faster than anybody predicted after the pandemic, and that did result in a slight increase in the unemployment rate, but it still remains under 4%, which is now the longest stretch since the 1960s. So very much a sign of strong, stable growth that we would want in a strong economy.
Even though we saw some cooling on that top line number, still a very tight job market, to your point. But given that we're seeing now fewer job openings, still quite a lot, right, but still fewer, and now more people entering the labor force, what's the prospect that the power will shift from the worker to the employer maybe come next year?
Yeah, so the president's economic policy, right, his Investing in America agenda has always been about not just addressing our roads and bridges and need for clean energy and the manufacturing boom, but creating more good jobs in all communities across the country. And we're seeing continued job growth in exactly that way. What we now are really focused on, especially here at the Department of Labor, is making sure that everybody has access to those jobs, that we're creating equitable pathways so that everybody can share in the prosperity that continues to characterize this economy under Bidenomics.
I want to ask you about the United Auto Workers Union talks right now. They have threatened to strike if they're not able to reach a deal with the major automakers. President Biden has expressed concern about a potential strike. What are you hearing now from both parties?
Right, so to take one step back on that, right, we've talked about, this tight labor market and workers having more power. One of the features of that is that unions also have more power to make demands at the bargaining table. And we've seen the positive effects of that over President Biden's tenure, right? We've seen increases in wages in bargaining agreements. We've seen addressing other issues, right? The Teamsters and UPS reached an agreement that also has air conditioning in trucks. Like, we're thinking about what makes a good job in multiple different ways. The president believes, as I do, in the collective bargaining process. And part of that is allowing the parties to do what they need to do, respecting that process, and encouraging them to stay at the table, which we want to see. But that is certainly what continues to happen, at least for now, in those UAW talks.
Really quick, you think we can avoid a strike?
I don't want to predict that, but I think anytime the parties are at the table and talking to each other, that's a good thing.
Speaking of unions, the Treasury put out a brand new white paper this week showing that unions help the middle class. Union workers can see wages of 10 to 15% higher, and that can actually spill over to help non-union workers. Though given that union membership is so low right now, what kind of impact can we expect to see? And if we had higher union membership, what type of a different job picture would we see in terms of both job creation and wage growth, which is already robust now?
Yeah, we're also seeing the highest level of support for unions in public opinion polls since 1965. So I also think that is not accidental, right? This is very much a part of when you have a president who is saying that we want an economy where workers get their fair share. We want the jobs we create as much as possible to be good union jobs because of those benefits, because of job security, because of wage growth, because of other kinds of benefits in union jobs that also have an upward effect on working conditions elsewhere, that those are all very, very positive things and very much a part of how the president sees a good, strong economy.
You and I have talked about closing the gender pay gap and women's equal pay. How do you think unions can play into perhaps closing that pay gap?
So studies show that unions have a positive effect on closing both the racial and the gender wage gaps. That's another reason why the more we can create good union jobs in all communities across the country, this is going to be a positive thing. Now, the Department of Labor is really focused on that access to those jobs, right? If you look at jobs like construction, those jobs still largely remain male-dominated. And so we are investing across the country in programs that are creating pathways for women. Like in Chicago, we are investing in a program called Women Building Infrastructure, Tradeswomen Building Infrastructure. And that's a way that we're going to expand more equitable access to job security and the kind of breathing room for families that we want.
Is there anything that the Labor Department can do specifically when it comes to writing rules to offer more transparency to help close the pay gap? Is there a way to prevent discrimination based on gender? Is there a way to mandate perhaps that women that have commensurate experience with men in the same position who are performing are entitled to and should get equal pay to their male counterpart?
So this is where it's really important for us to think about, everything we've talked about is about building the high road to the middle class, right? Good jobs, access to those good jobs in all communities. In order to do that, we also have to combat the low road, meaning we have to enforce the law to make sure that everybody's playing by the same set of rules. And that means that women should be paid in the workplace if there's a disparity in pay that is illegal, there should be enforcement of that. But the other piece of it, and we've talked about this before, is addressing occupational segregation, making sure that in these certain jobs, like I mentioned, construction, where women tend to be underrepresented, but they're good jobs, pathways to the middle class, that we open up those paths to women too.
Well, Secretary, I know this is an issue that you and I have talked about before, and I hope we can continue talking about it in the future. Thank you so much for your insight. I so appreciate it.
Thank you so much.